With me in studio now is Stuart Jeffrey. He's the head of technology equity research at Nomura Securities. He's a global communications equipment specialist. Stuart, welcome to the show. In this $12.5 billion buyout, there's also a $2.5 billion breakup fee embedded. It seems a tremendous amount for a breakup fee. Do you think Motorola is a little skeptical about this getting through the regulators?
Well, I think at $2.5 billion, it's pretty clear. Google's committed to it, Motorola's committed. I can see no reason why the regulators would balk at this. There's no real sort of issue between the two competing in the same areas, and so the only issue you have is too many patents being in too few hands, and Google doesn't have very many patents, so we don't really see why the regulator would block that kind of transaction. So
that $2.5 billion breakup fee not that onerous from your perspective?
No, I don't think so.
No. When you talk about the patents that Google's acquiring here, what is it that Motorola Mobility has that's most valuable to them?
So Motorola's got over 30 years of mobile-specific patents, a number of what are called essential patents. Essential patents are core to the standard in GSM, 3G, 4G, and so those are important patents. But the really exciting bit, potentially, are the non-essential patents, which are, as Motorola describe it, for areas that can differentiate the product significantly. There won't be very many cross-licenses signed for those specific patents, and so that's an area where Google can perhaps fight back against Microsoft in particular and Apple as they try and sue the Android makers over the past few quarters.
Some have already started to speculate that maybe there's interest in Google TV being able to expand more quickly because of some of the technology they'll obtain through Motorola Mobility. Is that really a promising expansion for you now?
I think it's a possibility, but that's very much secondary or tertiary to why this transaction's being done. The main reason is to get hold of the patents, to fight back against Apple, Nokia, and Microsoft. And I think owning the handset business and owning the set-top box business is very much secondary. As it happens, Apple is a long way ahead in terms of connecting the home, and Google does need to catch up, as does Microsoft. So this may help them a little bit, and I dare say Google will hold on to those assets for at least some period of time to understand how they can leverage Google TV better.
So how do they truly differentiate themselves from Apple through this? I mean, you're saying they're catching up here, but what makes a Google-Motorola tie-up that much more of a hefty competitor?
Well, again, I think that's very much secondary. The key thing here is just pure patents. At the moment, all of the Android vendors, HTC, Samsung, LG, are being sued by Microsoft and Apple. They have injunctions preventing them from selling their products into markets like Europe. And what Google's trying to do is build an umbrella, I suspect, of patent protection to stop the key Android guys coming through and selling their products. As a secondary thing, Apple has got this perfect connectivity almost between its devices and the home. It has iCloud coming up that provides that connectivity through the cloud and mobile as well. And those are things that Google is working at, but it hasn't quite got to the point where it's going to be fully integrated in the way that Apple has done so, or will have done so, by the time the new iPhone comes out.
The point has been made that in this acquisition, Motorola Mobility will still be sort of a standalone company, won't be necessarily absorbed fully. How important is that?
That's important for HTC and Samsung and LG and Sony Ericsson. They need to know that Google isn't in competition with them, but is simply setting itself up to provide protection from a patent perspective for all of those vendors. If there's a sense that Google is actually going to be competing with the other Android guys, then it might drive them to use Microsoft Windows Phone instead, for example.
Patent was said, what I heard 24 times on the conference call this morning. You've said it a number of times in this conversation. It is $12.5 billion at 63% premium over Friday's closing, the right value for those patents.
It's very hard to justify what the right value is. $12.5 billion.
But for shareholders, you think it's worth it? It's rewarding to them?
It's a strategic asset. So if you take out the cash that Motorola Mobility has, you're down to about $9 billion of enterprise value, and then you have about $20 billion of revenues underneath that relating to home and mobility. And so when you look at that, if they can just get 0.25 times sales for that in some kind of future transaction, then they'll be paying maybe $4 to $5 billion for those patents. They bid almost $4.5 billion for the Nortel patents. That was the winning bid for the Nortel patents. So from a like-for-like perspective, you'd argue that maybe the Motorola patents are worth more, and if $5 billion is the going rate, that's the going rate. But the ability to generate that amount of cash flow long-term is pretty unlikely. And so this has become a very strategic asset as opposed to a cash-generating asset, we feel.
All right, Stuart, thanks very much for giving us your analysis today.